All right. Assalamualaikum and very good morning. I have to proceed with the class today because I foresee that we're going to have a very busy month in May because myself especially because there'll be a few times. First of all, first week of May too, we have a public holiday, right? And then uh, the one of the week too, I have to be away. So therefore, I'm gonna foresee that we're gonna have a very busy May. So nak tak nak I have to do our session today lah. Because our meet is already 1 week earlier. And before we proceed, just to highlight, okay, I know it's not a good news to hear, but just prepare yourself for our midterm, and because based on the schedule or based on the calendar here, I can see that the week number 7 ni, we're gonna have a public holiday on Thursday. Right, so therefore, I will try to slot in our first or our midterm test on the 18th of May during class lah. Okay, so for the test, we're gonna use a physical classroom, and perhaps, in fact, after our break from Raya and also Wesak Day on the 4th of May. So on the 11th, okay, we will do our face-to-face class already. Okay, 11th of May, we will do our first face-to-face class. And on the 18th, the following week, will be our midterm test. And I will let you know in terms of what are the topics will be covered during the test. Okay, just a quick announcement before we start with our lecture today. And like I said, there'll be one of the week, perhaps on the 25th of May too, I will not be around. So therefore, alternatively, I might have to use videos as a source of lecture lah, for that particular week. How about group assignment? Yeah, the group assignment sekarang pun dah week berapa. On the 11th, I will announce to you what will be our group assignment after the holiday. On the 11th, I will announce what will be the group assignments. And on the 18th will be our test. All right. Hope it's clear. So for today, it is actually something that you are familiar with, I guess, because it is not typically new, right? Typically new because when we talk about financial statement analysis, therefore, we are talking about what are the sources of information, which is from the financial statements. And when we talk about financial statements, basically, the source comes from the annual reports. So first of all, we will discuss why we need to have these financial statements, annual reports available. Is there any regulatory requirements? Obviously, there is. And what are the elements that we have in the annual reports as the financial statements? And lastly, we're going to talk about how to analyze it, okay, the ratios, and how we do the information to do our analysis. All right. And as I mentioned, this is not new. I guess you've learned this before. So therefore, this will be very brief. So hopefully, if there's any questions, you're going to entertain that question as well, right? If there's any. So the process of financial statement analysis, or sometimes in short, we just simplify it as FSA, financial statement analysis, or FSA, consists of the application of analytical tools and techniques for analyzing financial statements. As I mentioned, the financial statements consist of few important statements or documents. Among others, we have the balance sheet, the income statements, and also the cash flow statements, right? And we're going to use this information to make decisions, because as an investors, or at least as an agent, or as an analyst, for example, we're going to need this information for making decisions, not only for ourselves, sometimes for our clients. So this process of financial analysis will try to meet certain objectives, and this can be used as a preliminary screening tools. Okay, preliminary screening tools, because when we use financial statement analysis, especially when we use financial ratios, we're gonna identify, okay, or we can see the snapshot of the positioning of the companies with regards to various factors or various conditions. So therefore, we can use this, right, as a forecasting tool, and at the same time, we're gonna use it for historical events. Okay, and we can see what are the current conditions, and from there we can forecast what will be the future conditions based on the company's performance. Right. So in terms of the regulatory requirement, as I mentioned, especially for public listed companies, right? For public listed companies, based on the Companies Act 2016, which repeat the original act in 1965, it requires all companies, okay, incorporated under the act to present their accounts, okay, in a manner so as to reflect a true and fair view on the financial position of the corporation. And this true and fair view must be made public. Okay. So in addition, amongst the listing requirement of Bursa Malaysia, all listed corporations have to provide their account in such a manner so to give true and fair view of their financial position, as I mentioned juga lah. So the accounts that report of their performances and financial position must be communicated to the public, in particular to the shareholders, ataupun to the stakeholders, in fact. Okay. So where can we get this information? Okay, obviously when they make an announcement, they can use Bursa website, for example, as a medium or as a channel to make public. They already publish, or their financial reports already available to be seen by the public. And obviously, most of the companies will publish their financial reports on their website. Okay, we as a member of public, as a potential investor, we can go to each and every, especially the public listed companies, on their websites to download and to see their financial reports, as compared to perhaps in the 1980s, whereby internet is not really a big thing during then. We are relying on physical annual reports. We are talking about, like a book of financial reports. They used to print it in box, okay, for the potential investors or even to their stakeholders. But nowadays, all right, with the technology, all of this information all can be downloaded directly from their websites. Okay, so when they publish in the in their website, automatically they fulfill their requirement according to the Companies Act. Okay, so dia bukan saja je publish. Okay, it is part of a regulatory requirements. So apart from the three, as I mentioned before, the balance sheets, the profit and loss ataupun the income statements, and also the cash flow statements, analysts, potential investors, or even investors should read the entire annual reports. Okay, not only these three statements, because these three statements is just few pages. Okay, they have a lot more information. Okay, so among others includes the chairman's report. Okay, the chairman of the company will provide a report or his or her remarks with regards to the company's performance throughout the year. Or information on the directors. Okay, who are the directors? What are their their qualifications, their experiences, you know, and their attendance in the meetings. Everything will be included in the information on the directors. List all the fixed assets of the company. Okay, their investments, where they invest their assets in. All right, the contingent liabilities, the auditor's report, because this auditor's report usually comes from the external, not usually, it must come from the external auditors. Okay, because again, it is based on requirement from the Companies Act. All the accounts needs to be audited by the external parties. As you all know, when we talk about external auditors, we have now the big four. I think still big four of audit firms. And usually when we talk about big companies, you know, the top 30 or top 50 companies in the country, usually relying on a very, you know, top audit firms. Okay, audit firms good because obviously they are, when we talk about big four, they are international companies, very well known. Okay, among others, we have, if I can recall now, the KPMG, in no particular order, KPMG. We have EY, Ernst & Young. Who else? Okay, kalau you ingat, you can help me with this. KPMG, EY. Who else? Okay, nak raya ni lupa. Okay, never mind. With the power of the internet. Yeah. PwC, PricewaterhouseCoopers, and Deloitte. Okay, so each and every one of these company is available in the country, and on top of that, they are obviously have their offices almost everywhere in the world. They have their offices, right? So besides this big four, obviously we have other international companies and even local companies for preparing or when we want to do external audits. Okay, but as I mentioned, big corporation, especially banks, okay, contohnya banks in the country will use one of these big four, right? And lastly, we can refer to the notes of the financial statement. When we see the notes, this is basically the explanation and the detailed part, okay, of all the information in terms of the assets, the liabilities, the equities, okay, in terms of inflows and outflows of the funds of the company. When we see the report, it's just a summary ataupun the total figure. So if we want to see the details of it, we need to refer to the notes, and the notes will be labeled or will be numbered in terms of the information. Okay, so yeah, these are all the information that we should read, right? Not only on the accounts itself, right? To have more understanding of the company's performance, especially for that particular year. Right. So these are the key financial statements, as I mentioned. We have number one, the balance sheet. Okay, statement of the accounting equation at the point of time. And as I mentioned, this will be usually reported annually. And from the balance sheet, we can see the snapshot on the position of the company. Okay. Next, we have the statement, the income statement ataupun the P&L, profit and loss account. And this statement will explain the movement between two balance sheet, meaning from current year against the previous year. And we're going to see the relationship between the revenues and the expenses, the incomes and the expenditures. Okay, so when we do the deductions between revenues and expenses, at the end, we're going to see whether the company will earn the profits or even loss. So if the revenues is more than the expenses throughout the year, obviously the company will generally generated profits throughout the year. However, if the revenues is less than the expenses, there are possibility that the company will suffer losses for the year. Okay, and this is the income statement. And the third one is the cash flow statements. All right, this explain the movement between two balance sheets. If earlier we're going to see in terms of profit, but now we're going to see the movement in terms of cash, okay, in terms of cash transactions. So therefore, any non-cash transactions, okay, you will not see it in the cash flow statement. Okay, so items like depreciation, for example, okay, you will not see it in the cash flow statements. Okay, depreciation, no. Okay, but you can see it in income statement or even in the balance sheets, but not in the cash flow statements. So this is the accounting equation I mentioned earlier. Okay, the statement of accounting equation, or sometimes balance sheet, also known as statement of financial position. Okay, another name for balance sheet is statement of financial position, ataupun tadi statement of the accounting equation. And this is basically a summary of the company's resources in the form of the assets. And you're going to balance it, hence the name balance sheet tadi, against the liabilities and also the equity. Okay, so from the total assets that the company have, right, from the total values of the assets that the company have, it must be balanced, or it must be funded, okay, funded by two different sources. Number one, from the liability side. Okay, liability, as you all know, is debts, utang. So, okay, so there are partial of the assets will be financed or be funded by liabilities or debt, and the other portion will comes from the equity, which is the owners of the company. Okay, so when these two combine, it will give us a total of the equivalent value of the total assets that they have. Okay, so this is the accounting equation that we use in the balance sheet. So the next slide will show you the general format, and I will show you the actual format as well that you're going to see in the annual reports or financial statements. And for example, asset listed near the top, usually considered liquid. Okay, when we talk about easily converted into cash, usually we are talking about how liquid are the assets. So the more liquid, the higher the positions in terms of the statements. And similarly, liabilities listed near top usually relates to the debts that are due in shorter time. Okay, that they have to settle within shorter period of time. So the higher the positions on top, it indicates short term ataupun current. Okay, short term ataupun current assets or even liabilities. So this would be the general format of the balance sheets. It used to be in a T account, okay, in a T account style, with on the left hand side we have the assets, and as mentioned from the previous slide, the ones on top are more liquid or easier to convert into cash or sooner to convert into cash as compared to the one at the bottom. Similarly, on the liabilities and equity sides on the right. The top parts is sooner for you to settle in terms of the due, okay, short term, and the one is long term in the middle, and the equity will be at the bottom right of the statements. So the total assets and the total liabilities and equity will generally give you the same values. So if you have a total asset worth of 100 million, your total liabilities and equity will have 100 million as well. Okay. All right. So this is the general format of the statement. However, most of the companies, right, in Malaysia will look ataupun their balance sheet will look something like this. Okay. Remember tadi, the name of the statement also known as statement of financial positions, right? Some companies still use balance sheet, okay, but most of the companies nowadays use the statement of financial position as the official name of this particular statement. Still assets, okay, on top, okay, but instead of a T account, it's more vertical looking statements, okay, whereby they have assets on top and liabilities and equity at the bottom. So instead of, left and right, it's more horizontal. Sorry, more vertical. Okay, kalau tadi tu horizontal for the T account, here we are vertical. So assets on top, liabilities and equity at the bottom. But the format ataupun the general rule still remain the same. The one yang shorter, okay, for example, in terms of assets, requires shorter time to convert into cash will be on top, and liabilities pun sama. Those who are due quickly ataupun in short times will be on top of the account. Okay, so note that this value, for example, the total assets about 10 billion, 10.9 billion is the same as total liabilities and also equity. And notice that we have two sets of information. We have the group information and we have the bank information, because this is a bank punya account. Sometimes they use group, and instead of bank, they use company. And they give you a 2 years information, 2 years of reports. The current year, the current statement, for example, for this case, this is actually annual report for 2010. And they give you the previous year's information as well, 2009, for comparison purposes. Okay, we can see whether the cash increased or not. For example, for this particular bank, if we look from the group perspective, 2009 is 2.8, then it reduced to 2.6 billion. Okay, so there's a reduction of cash, for example. And if you can see, in terms of the total assets, also reduced. Okay, so if you want to know what happened, we can read all the notes. Remember, one of the important things that you need to refer to is the note to the financial statement. So the numbering here will allow us to refer easily at the back of the financial statements. Okay. Similarly, for the liabilities and also for the equity. So you can see, okay, the share capital, you can see, or you can refer to note number 25, the reserves, note 26. So if you want to see the liabilities part, yeah, then you can see specifically which part of liabilities you want to see, right? So all of this can be referred to lah in the notes of financial statement. So this is the general information that you have in the balance sheets. You have assets, as I mentioned, on one side, and in general, okay, the assets can be grouped into two categories. First is the current assets. Those on top of the account usually are the current assets, whereby these current assets required for their day-to-day operations. And among others, they have cash, inventories, if they are involved with trading. For example, they have stocks that they want to sell to the customers. Marketable securities. Okay, what are marketable securities? This is basically short-term investment. Okay, short-term investment. And receivables. Okay, so if they sell their products, goods, or even services to their customers on a credit basis, so meaning they give credit to their customers, right? So this credit amount will be recorded under receivables. Okay, and all of this information, ataupun all of these assets can or will be converted into cash within 1 year. Okay, so this 1 year will be the general rule, whether they will be part of current assets or not. So if the assets requires more than 1 year, it will not be part of the current assets. Okay, current asset must be convertible into cash within 1 year. Right? And the second category is the non-current asset, or sometimes known as the fixed assets. Okay, so these resources intended to be used in the course of business, such as equipment, land, buildings, plant and equipment, motor vehicles, right? All their real estates, property, okay, will be part of their fixed assets. So these assets, in order to acquire them, will require long term. Okay, you're going to use them for long term basis, and it will be not so easily to be converted into cash. Okay, yes, you can convert it in a short period of time. Sometimes some of the assets, however, you might have to suffer the losing of value if you want to cash in the assets in a short period of time. Okay. And another rule for fixed assets, usually we're going to see the fixed asset either in gross or at the book value, whereby if we take the net value, we're going to take the gross minus the accumulated depreciation. All right, and on top of these physical resources, okay, physical assets that they have, some firms may have what we call as intangible assets. Okay, intangible assets. So assets such as patents, goodwill, copyrights, maybe trademark, those which are considered intangible, we cannot see, we just have a document to say that we have a trademark or patent for a certain products, for example, and this is considered valuable to the company. It have values, part of their assets. Okay, we can put it under non-current asset as well. However, this will not usually be used in our analysis later on. Okay. On the other side, we have the liabilities. Okay, liabilities. And as I mentioned, liabilities usually used to finance, okay, our assets. And as a form of debt, and this amount can be, extracted, ataupun we can get it from either the suppliers, the bank, or even the government if we borrow money from them, right? If you get funding from the government even. So similar like assets, we can categorize it under the current and also non-current. Okay, short term versus long term. And again, the 1 year period will be our threshold. So if the nature of our debt is payable within 1 year, it's going to be under current liabilities. And if we need to pay them more than 1 year, it will be under long-term liabilities. Okay, any obligations due and payable within 1 year, kita letak dalam current liabilities. Example, we have account payables, accruals, and even notes payables. Okay, so the opposite of receivables earlier, account payables is actually amount that the company owe to the, for example, the suppliers. Okay, they purchase their materials from the suppliers. However, they don't pay for the material just yet. Okay, so it will be parked under payables. Similar goes to accruals. Accruals here referring to the services that they already used as part of their business. However, they don't pay for it yet. Okay, and notes payable is basically short-term loan. Okay, short-term loan that they have to pay within 1 year. So anything more than 1 year will be parked under long-term liabilities. Okay, that due or payable beyond 1 year. So here we have term loans. Okay, usually term loans between 3 to 5 years maybe. Okay, 3 to 5 years. We have debentures, bonds. Okay, so these are very long term, 10 to 30 years. Right, they have mortgages, leases. Okay, mortgages ni, yeah, again, depending on the products, some might be 5 years maybe. Okay, depending on the assets or equipment that they purchase using mortgage, or even properties they use mortgage, for example. So it will be even longer lah. Okay, kalau property maybe even longer, 5 to 20 years maybe. Okay, so like I said, more than 1 year, we will put it under long-term liabilities. And the final part of the balance sheet is the owner's equity. Okay, so the finance obtained directly from the owners, including the undistributed profits. And these undistributed profits are actually referring to this retained earning. Okay, the amount of profit that the company don't distribute to the shareholders, they will redistribute back to the company. Ataupun it will be retained in the company, and hence the name retained earnings. Okay, and on top of that, we have the preferred shares ataupun preferred stocks, common stocks, and even trading capital that they put during the initial setup of the company. Okay, their trading capital. Right. Okay. The next statement, the second statement, is called income statement, and it summarizes the inflows and outflows, the incomes and the expenses of the company for the same period of time. Okay, so kalau tadi the balance sheet, let's say for 2020, so similarly the income statement will cover the same period, 2020 as well. Okay, so the items or the elements that we have in the income statement includes the revenues, all the incomes, the sales information will be recorded in the revenue side. And then we have all the costs and expenses incurred throughout the year. Okay. And the difference between the two, like I said, will indicate whether the company have profits or loss after we subtract the expenses from the revenues. Okay, so if we subtract expenses from revenues and we get the positive values, that indicates profits. And again, alternatively, if it's negative values, then it shows that the company suffer losses. So this would be the information that we have. Okay, the revenues, the sales, the cost of goods sold, okay, cost to produce or cost to acquire the goods or services, all the operating expenses. The nature of operating expenses is basically all the expenditures that the company requires to run their business. It includes the marketing punya cost, the admin expenses, including admin costs, includes salary, all the utilities, okay, all part under administrations. And then we have interest or the financing costs. This is also important in the income statement, especially if they have financing. And then the tax expenses, which payable to the government, the income tax, company tax. And finally, after we deduct all the costs, the expenses, the interest, and even the tax, we're going to see whether the company have a net income or even net loss lah kalau dia negative. Okay, and this net income is distributable to the shareholders. Okay, even though we will not distribute 100% from net income to the shareholders, so there will be some portion of this net income will be distributed to the shareholders. Okay. So this is the general format of the income statement. Okay, revenues on top, minus cost of goods sold, get the gross profit. This is our first level of profit, gross profit. And then we deduct the operating expenses and even depreciation if we have to get the operating income, or also known as earning before interest and taxes. Okay, earning before interest and taxes. And then we add other income, if any. Then we deduct the interest. Okay, sometimes other income ni pun boleh masuk dekat atas other revenues. And then after deducting interest, we have earning before taxes. Okay, kalau tadi earning before interest and taxes. Now after we deduct the interest, we left with earning before taxes. And then we deduct the corporate taxes to get the net income. Or like I said, there's a possibility of net loss juga. So if you get a negative amount, you're going to see a net loss of the company. And this amount, net income, is distributable to the shareholders. So they can pay dividend either to the preferred stockholders or the common stockholders. Okay, so after we deduct the dividend, so this is the portion of the undistributable ataupun the undistributed earnings. Okay, so this amount will be parked in the retained earnings. Okay, and you recall retained earnings is part of the equity of the company. So this amount will be transferred in the balance sheet as well. Okay, so this is a income statements in the actual annual reports. Okay, so they have the revenues, the sale on top, and then any other income, they put it here. So they give you the total gross income. So in this case, they don't have cost of goods sold because this is a bank. So they list all the expenses, the impairments. First, they deduct all the impairments to get the net income. This is not the net income after tax. This is the total net income before deducting all the expenses. So these are the expenses that the company have. Personnel, obviously, this is with all the salaries lah. Salaries masuk dalam personnel. They have the overheads and any other expenditures. Okay, all the cost of utilities, cost of marketing, expenditures, everything masuk dalam ni. And then they have the finance costs. Okay, so since this is a Islamic bank, they don't have interest lah. They have finance costs, right? And for this company, they have ataupun they suffer loss before tax, before zakat and tax. Okay, the company paid zakat as well, and then tax as well. So at the end, this company suffered net loss for the year. Okay, and they even though they lost, the amount they extract to the equity holders lah. All right, so these are the value of the not earning per share but loss per share. So the company or the shareholders suffers losses in terms of the earnings for that particular year. Anyway, the third statement is cash flow. So during a period of time, the cash flow statement provides, as I said, the inflows and outflows related to cash only. Okay, cash only. Kalau yang tadi ni, the income statement, including non-cash, but for cash flow, we are looking for cash transactions only. So we're going to see the inflows and outflows. So the inflows indicates the receipts. Okay, and the outflows the usage of the cash. And they separate, again, the statements into three separate activities: the operating activities, or the operation side, the investment activities, and also the financing activities. Okay. So some of the operating can be positive, can be negative, meaning there will be some inflows and outflows. Investment, depending whether they have, most of the time their investment will be outflows because they invest outside, unless there are incoming money from third party that invest in their business, then they might have a positive ataupun cash inflows. And financing, again, there will be some perhaps inflows and even outflows. So why we have cash flows? To highlight the inflows ataupun the flows of the money internally or externally from three different activities. This can be used for short-term planning. And cash flow will give us better understanding on the liquidity positions of the company, because in the cash flow statements, okay, bear with me. Kalau contoh tadi bank tadi, we have cash ni kan. We have the cash of 2.6 billion for 2010. So the movement of cash in and out from these 2 billion can be seen here. Can be seen dalam cash flow statements. Okay, so at the end, ataupun the end product of cash flows will indicate that 2.6 billion, the incoming and the outgoing money can be seen from there lah. Okay, efficient cash management or not, we can see, and we can predict the sickness of the positioning ataupun the liquidity of the company. If they are not properly maintained ataupun not well managed, we can see the sickness from the cash flows. We can compare it with the budget and the current position, macam I cakap tadi. So the inflows and the outflows come from the three different activities, and the funds, for example, number one, from the operating activities, when the cash receipts, asset cash expenditures, dia akan jadi inflows to the company. Okay, maknanya the incoming money is more than the outgoing. So therefore, it will be inflows. Okay, tapi dia the opposite kalau dia, the opposite lah kalau dia the other way around, meaning it will be outflow kat bawah ni. So it have a negative impact kat sini. Similarly, the investing activities will be inflow if they sell their properties more than the investment activities. So meaning the process of liquidating the assets, sales of equity and shares will be inflows to the company. But if the companies invest or purchase a property, invest more on others, company give loans to other entities, will be outflows. Ni sepatutnya kat bawah ni ada outflow lah. Outflow. So, and finally, financing activities. If they issue bonds, they issue sukuk, they issue shares, it will be cash flow to the company. However, if they make payments, redemption of the debt, redemption of the bond, reacquisition of capital stocks, all of these requires cash, so therefore their cash will be outflow. Okay, so these are the nature of transaction that indicates whether they have inflows or outflows of the cash movement. Okay, so nanti baca lah ni the classification of business activities, what they have in the operating activities. Like I said, when we talk about operating, all relates dengan day-to-day operation, including sales, payment, purchases, okay, payment, pay tax, pay wages. Right, so all of these are operating. Kalau investment relates with properties, they purchase fixed assets. The sale of fixed asset, purchase of fixed assets, receive of dividend or interest, and if they borrow money, ataupun kalau borrow money kat sini borrow money, inflows, ataupun if they invest in other working capital, will be outflows. And financing refers to usually to the borrowing, whether using bonds, debentures ni is also bond, ataupun they use equity, preference ke, they use common stocks ataupun the issuance of common stocks, for example, all part of the financing activities. So, okay. So those are the statements. So these three statements, the balance sheet, the income statement, and the cash flow statements will be our important documents. Okay, important documents before we do our analysis. So in this case, the analysis that we use is financial ratios. Okay, this is the financial, like the types of analysis that we use to make decisions and to measure the performance of the company. But before we move on with the financial ratios, perhaps we can take a quick break, maybe 5 minutes, before we move on with the financial ratios. Okay, so we're going to discuss the analysis part, okay, of our financial statements. And as I mentioned, we're going to use financial ratios. And why we use financial ratios, ataupun what is financial ratios? It is a type of analysis that used to measure the current performance of the company, the past performance as well. And we, in fact, can use for forecasting purposes based on the pro forma or what if statements, all right? And for this topic, ataupun in this topic number 3, we're just going to base on the past performances sahaja. Okay, because when we talk about current performance, this is usually information that only the internal parties will have, right? The managers, the owners of the company will have the current information. So therefore, they use financial ratios to measure the current performance. But for us, the external parties, the investors, the analysts, we're going to use the past performances, right? And these past performances, as I mentioned, we're going to extract the statements, the reports from their website, for example, and we do analysis based on that. Okay. And in terms of pro forma or what if statements, this is actually will be discussed in other topics or perhaps in other courses even. Okay. So not for this particular course lah. So this ataupun for this particular topic. So basically the financial statements that we have will be used together. Okay, all the balance sheet and income statements and even cash flow sometimes will be used together. And we are actually belong to this group, okay, other interested parties. Okay, as analysts, as investor, we are the other interested parties to analyze and interpret the firm's financial positions and financial performance. So again, if you see the financial position, this is basically referring to the balance sheet. And the performance, we are going to refer to the income statement. Okay, so by doing this analysis, we're going to see whether the company has a very good condition or not. And internally, the financial managers can uncover the trends, strengths and weaknesses to how to make do or how to strengthen the company, right? And they can take appropriate actions. right? But for us, like I said, we are external parties. We are basically going to use this number one. So these are the categories of financial ratios. So we have five. And as I mentioned earlier, I believe you've done this before. Okay, so I will not go all financial ratios because we have a lot here. I'm just going to refresh you with uh, the basic information of the ratios, what would be the formulas, and how to read the results of the formula and or the ratios, and how to interpret and how to compare the performance based on the financial ratios. And I will share with you as well a simple exercise that we can see and measure or calculate the relevant financial ratios that we have. Anyway, the first category is known as liquidity ratios. And these liquidity ratios referring to the firm's resources. Okay, we want to measure how the liquid resources available for them to cover or to pay the current and maturing liabilities on time. Okay, so the higher the ratio, the better as a basic rule. However, if it is considered excessive, then it shows that we are inefficient. Okay, we are unable to generate more cash ataupun more returns if we have excessive liquidity. Okay, however, if you have very low financial ratios ataupun very low current ratios ataupun liquidity ratios, it indicates that you have technical insolvency issues and may lead to low profits and even considered as not productive, right? So there are three types of liquidity ratios. We have the current ratio, quick ratio, and also net working capital. So current ratio, we use this formula, current assets divided by current liabilities. Okay, current assets divided by current liabilities. And the average current ratio that they put in as at 1.5 times. So the answer is in times. And the higher the ratio, the better in terms of shows their ability to pay short-term obligations on time. Okay, to pay the short-term obligations on time. So if we have higher assets, for example, than current asset as compared to current liabilities, obviously your current ratio will be high. Okay, tapi kalau if your current liabilities is more than current assets, you will get the ratios of less than 1. Okay, so anything less than 1 considered not good. Okay, not good as far as the current ratio is concerned. And quick ratio number 2, okay, is the extension of the current ratio. Okay, the only difference would be the current assets will be excluding the inventory and prepaid expenses. Okay, these two items will be removed from the current assets, and we're going to divide them still with the current liabilities. Okay, so this is a measurement that will test whether they still have the capability to pay short-term obligations or not without relying on the least liquid assets such as inventories and even prepaid expenses. Okay, so the results, how to read the results? Okay, the answer is still in times. Okay, so the higher the ratio, it reflects the ability to pay short-term obligations without relying on inventories and prepaid expenses. And why these two? As I mentioned, because these two are considered as the least liquid current assets. Okay, and finally, the third one is net working capital. So when we do net working capital, we're gonna get it in ringgit, okay, as an absolute measurement. So when we take current assets and we minus the current liabilities, we're gonna get the absolute amount. So if it's positive, so it indicates that value will be the amount of liquidity that they have. Okay, and if it's negative, so it indicates that they have very worrisome like liquidity position, sebab dia ada negative amounts. Okay. Bear with me 1 second. You have the notes just now. So I have this question. Okay. So far I've discussed the current ratio and quick ratio. So in 15 minutes, can you help me to calculate all these relevant ratios that we have based from the notes that I gave you? Okay, you dah ada notes tu, handout so. Okay, please do the relevant analysis, then kita compare kejap lagi jawapan. Okay, so I'll give you 10 to 15 minutes to try. Right. Okay, so based on uh the slides that I shared with you just now, okay, we've discussed the current and also the quick ratio. Okay, give me 1 second. See, my calculator. Okay, so if you recall, our current ratio, the formula, if I can put my um, so current ratio, 1 second, let me reshare with you. I'm gonna use whiteboard here. Oh, I have to stop sharing this with you. Uh, second. Okay. All right. So sorry about the delay. But anyway, finally, I can write on this. So based on the current ratio just now, smoother. Okay. Okay. Let me try again. All right, so I have to improvise. Yeah, I have to improvise. So this is the question. So I'm going to use the PowerPoint again. Right, so our very first ratio just now was current ratio. And if you recall, the formula is current assets and we divide with current liabilities. Okay. And to get these two information, it comes from the balance sheets. Okay. And as you can see here, the top part is the current assets. So these are your current assets: cash and equivalents, account receivable, inventories, and prepayments. And this is basically your fixed assets. Okay, nets, fixed assets. And on the left-hand side, sorry, on your right-hand side, these two, okay, is your current liabilities. Okay, current liabilities. And this is your long-term liabilities, the long-term debt. And the bottom three is your equity. Okay, so that's how we label them first. Right, so to answer your current ratio, okay, so we need to find the total values of your current assets. So in this case, it's 40,100 plus 98,600, 129,200, and also 10,800. So it's about 278,700 ringgit. That's your total value of current assets. And your current liabilities is this side, which is 190 and 30,000, so 220,000. So when you divide with 220,000, give you around 1.27 times. Okay, 1.27 times. So this is the result of Era Baru Berhad's current ratio. So this company has a current ratio of 1.27. So generally, the amount of assets, current assets that they have, can cover the current liabilities. Okay, because it's more. However, if you compare it against the industry average, we can see that the industry is actually have higher current ratio, 2.15, as compared to 1.27 from the company Era Baru. So what can we conclude here? We can see that Era Baru Berhad's current ratio is lower than the industry average, which indicates they have less capability to pay their short-term obligations on time. Okay, so that's how we analyze the performance. Okay, so they have less capability. 1.27 is lower than 2.55. So therefore, we say they have less capability or less ability to pay short-term obligations on time as compared to the industry average. Okay, so that's how we do the current ratio. And similarly, we can calculate for the quick ratio, QR. And if you recall again, the formula is current assets, but you have to deduct or you have to minus the inventories and also the prepaid expenses or prepayments. So in this case, they have both, okay, inventories and also prepayments. So if you take 278,700 and you deduct these two, 278,700 minus 129,200, the inventories, and minus 10,800 for the prepayments. So now we're left with 138,700. Okay, and still we're gonna divide by 220,000. So we have 0.63 times. Okay, so the quick ratio also lower as compared to the industry average of 1.15. So what can we conclude from this? You can say that Era Baru Berhad's quick ratio is lower than the industry average, which indicates that the company has lower ability to pay its short-term obligations on time without relying on inventories and prepayments. Okay, they have less ability to pay short-term obligations on time without relying on inventories and prepayments as compared to the industry average. So that's how we measure or how we comment on the performance of the company as compared to the industry average. So that's why here, as you can see, the question asks you to calculate 8 financial ratios first. Okay, so this is the calculation yang I tunjuk on right ni. And the comments that I mentioned earlier is actually to evaluate the performance as compared to the industry average. So that's how you comment. Okay, I recap balik. I just take, for example, quick ratio. So how you evaluate and how you comment and compare the performance, you can see that Era Baru Berhad's quick ratio has lower ratio as compared to the industry average, which indicates that the company has lower ability to pay short-term obligations on time without relying on inventories and prepayments as compared to the industry average. Okay, so we always comment on the company, not on the industry average. So in this case, they have lower ability. Okay, so maybe we can take a look at other ratios. Okay, so for the rest of the ratios, like I said, you can refer in the notes what are the ratios. But for example, if we look at inventory turnover, ITO, inventory turnover, the formula for inventory turnover would be cost of goods sold divided by inventories. Okay, cost of goods sold divided by inventories. So cost of goods sold is here, 410,000. And the inventories is 129,200. Okay, 2.17, very good. Thank you, Clarissa. 3.17. Okay, so again, the inventory turnover, the answer is in times. So if you compare against the industry average, okay, for this time around, the inventory turnover for the company is better, the inventory turnover from the industry average, okay, as compared to the liquidity, the inventory turnover is better for the company. So therefore, we can see that The company has better performance as compared to the industry average because they have higher inventory turnover of 3.17 against 3.10 of the industry average. Okay. And the fourth one, fixed asset turnover. Okay, so for fixed asset turnover, the formula is sales divided by fixed asset. Okay, anybody? Ada jawapan dia? So sales is 670,000. 2.39 So fixed asset dia is this one, 280, 500. Berapa tadi? 2.39 Okay. Okay, 2.39 times. So you get the idea how it works, right? Maybe I can do two more. So I just random pilih je out of these four. Let's do operating profit margin. Okay, operating profit margin. This one. So operating profit margin, the formula would be operating profit. Okay, operating profit ataupun operating income. And we divide with sales. So operating income you would be 80,000. And your sales is 670,000. And note that the answer for operating profit margin is in percentage. So therefore you have to multiply with 100. So this one berapa? AC divided by 670, 12%. Okay. Ataupun kalau nak bagi precise, it's about 11.94%. Okay, bolehlah 12%. Okay, note that they have one decimal kat sini 15.5. So it's actually better to have at least one decimal for comparison purposes. Okay, I letak apa? 11.9 lah. Percent. So again, in terms of the profitability, because when we talk about gross profit or even operating profit margin, this is actually referring to the profitability ratios of the company. So in terms of the operating profit margin, the companies, Era Baru Berhad, has less ability of conversion of operating profit from their sales as compared to the industry average. So for every comments, for every evaluation, okay, you can actually refer to the bottom part. So the bottom part, this is all the explanation. So every ratio you boleh tengok kat sini. Macam ni indicates better productivity with regards to the operations. Okay, using their sales. Okay, so majority of our ratios, okay, we can use these two information, the balance sheet and also income statement. Okay, however, there's one category of ratio which is known as the market or equity ratios, whereby we need more information. We cannot rely just on balance sheet and also income statement. Right, some of the information is not available in these two documents, right? But for this question, they asked us to find earning per share, which is one of the ratio under market and equity. Okay, and this is the only ratio that we can calculate, but we need to use additional information. Okay, so for earning per share, the formula is actually net income, earnings, divided by number of shares outstanding. Okay, or no so. So what does it mean? Okay, what is no so? Number of shares outstanding. So number of shares outstanding relates with the equity. It relates with the equity. whereby we want to know how many number of shares is available in the market for time being. So in order to find this information, we need to refer to this common stocks or common shares. Okay, we know the total value is 100,000. Okay, for these common shares, the total value is 100,000. And for every one single unit of the common stocks, it's valued at 2 ringgit. Okay, it's valued at 2 ringgit. So what does it mean? In order to get the numbers, how many units available from the total value of 100. So basically, find also, you need to take the common stocks, divide by the par value. Okay, common stocks, divide by the par value. So since the common stock is valued at 100,000 and the par value is 2 ringgit, so the number of shares outstanding is equivalent to 50,000 units. Okay, 50,000 units. So since we have this 50,000, just take the income of 52,500 divide by 50,000 units. 1.05, thank you. 1 ringgit and 5 cents. Okay, 1 ringgit and 5 cents. So you can see that for this company, Era Baru Berhad, the earnings for every single shareholders is equivalent to 1 ringgit and 5 cents. Okay, but this is not amount of dividend, this is amount of earnings for every single shareholders. Okay, so in order to determine how much dividend actually that usually they can generate, we can calculate another one, which is known as dividend per share. But unfortunately, for this question, we don't know the dividends payment. Okay, so that's why for majority of market or equity ratios, we need more information in terms of dividend payment. We need to know the share price. Okay, then we can measure a lot more ratios. Okay, so this is basically how we use historical data from balance sheet and income statement to measure the financial ratios. And you can refer later on in terms of what are the items that we need in order to measure the relevant ratios. Okay, the third category is activity. We have another 5. I showed you based on the example, the inventory turnover and also the fixed asset turnover. For inventory turnover, it's quite special because we use cost of goods sold instead of sales, because the rest of turnovers ratios are using sales actually. But if the cost of goods sold is not available, then you can use sales figure, okay, as a replacement. But inventory turnover would be the only ratio, the only turnover ratio that use cost of goods sold. So for the rest, for example, account receivable turnover, use sales. Fixed asset turnover, use sales. Total asset turnover, also use sales. Okay, and then we have profitability. We have 6 ratios. Okay, we managed to use operating profit margin just now, but we have another 5 ratios. All the margins, these 3 margins are using sales. Okay, when you see margin, you know it's equivalent to sales. So gross profit margin, meaning gross profit divided by sales. Operating profit margin is operating profit divided by sales, and net profit margin also the same, net profit divided by sales. And for the return on equity and also return on assets, this return, okay, for this particular ratio are actually referring to net income or net profit. So meaning from the name of the ratio is actually net income divided by equity, and this is net income divided by assets. Okay, so as simple as that lah. So all of this information, for profitability, we are using percentage. So most of the ratios we need to multiply by 100. Okay, and this is the only ratio under the profitability that the lower the better. Okay, under operating ratio. This is the only ratio under profitability. That is, the lower the ratio, the better it is, because we are measuring the expenses. Okay, yang lain tadi kita measures the profit. So therefore, we want it to be as high as possible. But for operating ratio, we want it to be as low as possible. Okay, because low ratio indicates better efficiency. Okay, still using sales juga as a denominator. Okay, net profit ratio, net profit divided by sales. Okay, this is the alternative name, earning after tax, net income, net profit. Okay, all are referring to the same thing. Okay, net income divided by total assets, net income divided by total equity. Right, and the last ratio, market ataupun equity ratios, important for public listed companies, right? And we need a lot of information as I mentioned tadi lah, including market price, and then we have no-so just now. So we have another 6. So from the question, we can calculate earning per share. But the rest, we need other information, including dividend. Okay, we have 3 dividend ratios kat sini. And price and earning, we need the market price. Okay. So again, earning per share is just like I mentioned, is earning after tax, sorry, ataupun net income, net profit divided by number of shares outstanding, or no-so. For dividend per share is dividend divided by no-so, number of shares outstanding. For dividend payout ratio is basically dividend paid per share divided by earning per share. Okay, and since this is both per share basis, we are actually can use alternative measurement would be dividend divided by net income. Okay, we can use this as alternative measurement. Okay, because dividend per share is dividend divided by no-so. Okay, untuk earning per share is net income divided by no-so as well, kan? Okay, so you can eliminate these two and use just dividend divided by net income as an alternative measurement for dividend payout ratio. Okay. Dividend yield, again, we need dividend per share divided by price per share. So this is the market price that we need. Book value per share, we need common equity versus shares outstanding. So for this book value per share, we can use from the original example. Common share tadi is 100,000. 1,000 and the shares outstanding is kita kira tadi 50,000. So the book value is equivalent to the par value just now, which is RM2. Okay. The market price normally above the book value ataupun the par value, right? And lastly, PE ratio. PE ratio ataupun price earning ratio. Again, we need the market price and also the earning per share. Okay, so this market price that we don't have in the example, but if you do your own analysis, obviously we can find the market price from multiple sources in order to determine the PE ratios. Right, so if we refer the ratios as it is, okay, without comparing it with others information, it is considered worthless information, right? Not we can say there's not enough meanings to it. Okay, so therefore, there are 3 ways how to interpret the ratios. Okay, number 1 is by using trend analysis. Okay, whereby we compare based on time series. Okay, meaning we measure one company for multiple years. Okay, so proper analysis usually requires at least 3 years with a maximum of 5 years. So between 3 to 5 years, so that you can see better in terms of the performance. Okay, so for time series, usually you can plot it in a graph. 2020, 2021, 2022 contohnya. So you can plot the performance. like that. Example. Okay, by using time series, or is it increasing like this, or you can see it's downward sloping like that. Okay, but bear in mind, some ratio, the higher the better. So if that's the case, this indicates kalau the look of the graph, something like this, it indicates the good performance of the company lah. They are improving in terms of the ratios. Ratio can be lah profitability, liquidity, efficiency, markets. Okay, and some other ratios, the lower the better. Okay, so you cannot say all the time this is a good ratio ataupun good graphs. Okay, for example, kalau melibatkan debts, liability, so this ratio is not a good sign if you relate dengan debts, because it shows that the company have more debts along the years. Okay, so it's not a good sign pula kalau macam ni. Okay, so this is trend analysis, right? Number 2 is comparative. The one that we did from the exercise just now, that's an example of comparative, whereby you compare the company against another peers, for example, ataupun the industry average. So from the question, we use industry average, okay? Or we can compare with other companies within the same time frame, must be the same time frame. So if you compare from 2022, you need to compare the other companies 2022 as well, not from other years, okay? Or else you will not be fair if you compare from two different time frame. Right? So for comparative, it's basically two or more companies, but only for 1 year. Okay, again, yang number 1 tadi, time series, one company, multiple years. For this time, multiple companies, 1 year. Okay, within the same time frame. Okay, but the most comprehensive types of analysis is actually combined. Okay, ataupun sometimes we just call them hybrid analysis. Okay, so this is the most informative approach, whereby it combines both trend and comparative analysis. Okay, so meaning they have multiple years and they have multiple companies. So therefore, the analysis is more informative, more meaningful, and better for analysts when we do comparison. Okay. So obviously they have some limitations. So nanti you read lah on your own, the limitations. So with that, that's the end of topic number 3. So for next meeting, which like I said in the very beginning, because next week we don't have class, midterm break, and during the Raya break. And then the following week on the 7th of May, 4th of May, 4th of May, on Thursday as well, we have a public holiday, which is Saturday. So we don't have class on that. So we will see on the 11th, okay, 11th of May. So 11th of May will be face-to-face meeting for our very first time. Okay, kita tak pernah ada face-to-face lagi. I will let you know where will be our class. Okay, tentatively, it will be in the Bursa room. Okay, at level 2, block 10. And on the 18th of May will be our midterm. Okay, midterm test will be on the 18th. Okay, so whichever topics covered until on the 11th will be our basis for our midterm then. Okay, whatever that we've discussed from the previous topic, for example, today's topic, and even the one that we will discuss on the 11th, will be part of the 18th midterm test. Okay, tentatively, I will let you know later juga lah for that thing. Right, any questions? Right. So thank you very much for your time, for your participation. Right. So for those yang coming today, maybe perhaps as an incentive, we'll give you some bonus marks because you make it to the class today. Thank you very much. And I will take the attendance from the web conference. So I'll see you guys on the 11th. All right. So thank you very much. Selamat Hari Raya for those celebrating. And I'll see you guys soon. All right. Bye and Assalamualaikum.
Waalaikumsalam. Thank you, Doctor.